Welcome to the California The Dream for All Shared Appreciation Loan. CalHFA is introducing a new loan to make home affordability possible. So today I want to get started by talking a little bit about the program and how you can qualify, and if the program has already launched after March 27th, how you can still get approved if the funds are still available. So who am I? I've been in the credit and mortgage industry since the first recession, and I specialize in leveraging your home and your credit to build your worth. And this program specifically talks about building your worth because if you don't have 20% to put down into a home, this is a program that can get you started with just a little bit of, or maybe no money down. So the first thing we're going to talk about is CalHFA and what is it? So it's the California Housing Finance Agency. It was established in 1975 and it's the state's affordable housing lender. They work in congruent with other lenders as well to make sure that they'll provide the funds and the guidelines of what needs to be followed for this to be pulled off. They help communities with housing opportunities for all Californians, and they collaborate with state and local federal government to provide affordable housing for the first-time home buyers. These programs are subject to change based on funding and the market conditions as well. So buying your first home with CalHFA. The California Dream for All Shared Appreciation Loan is coming out on March 27th, 2023. So this is the state's budget established for the Dream for All program that is allocated funds to CalHFA to administer this program with board and parameters on some of the specific requirements which are going to be coming out on that day for lenders. But we do have some information that we want to share with you so you have what you need to be able to apply or to get ready. So this is the home equity has proven to be one of the strongest ways for families to build and pass on wealth to their families, because the hardest part is getting your foot in the door and building that equity over time. So CalHFA is committed to improving the equitable access to homeownership to all Californians. So the Dream for All Shared Appreciation Loan, this type of loan is a down payment assistance program for first-time home buyers to be used in conjunction with Dream for All conventional first mortgage for down payment and or closing costs. So this program will be available Monday, March 27, 2023. So how does this program work and how can you take advantage of it? So you can access up to 20% assistance for down payment on a purchase, on the purchase price or the appraised value, whichever one is lower. The assistance on the funds can be used as a down payment or closing cost. So you can use maybe 17% of the down payment and then the closing cost 3%. There is no right or wrong way to do it. It's just strategically you have to think, what is a long-term plan for you and your family? So using the full 20% down payment will eliminate your mortgage insurance, which would save you monthly on your payment. So how does this work? When you put down 20% on a home loan, one of the first things is that your payment's going to be lower, not only because the balance that you're financing is lower, but you don't have to pay mortgage insurance, which mortgage insurance is in place because if in the case of you default, they have this insurance to be able to cover if you default. Now, using this assistance can cover down payment and closing costs, but it will result that the least out of pocket buying experience for you. So what does that mean? Is that if you go with the down payment assistance program, you can use all of it, or you can, if you don't have your closing costs, which is usually around 2% of whatever you're buying, then you may need to split it up. But the downside of that is that you will be required to pay monthly mortgage insurance. So right now we are in a market that if you can get the seller to pay for your closing costs, now you come in with 20%, the seller pays for your closing costs, and virtually you'll come in with zero because there's still going to be some costs like credit report or the appraisal or your home inspection. So still expect to have some sort of cost with this type of loan or any type of loan. The other component of this loan is that it's a one-to-one equity share appreciation with the property applies. So what does this mean? So as the property gains value, this program is designed that they will also collect a percentage of that. So for example, if you go in and use all of the 20% of assistance, the state will have 20% equity share on whatever you make over the life of this loan. If you only use partial, so let's say 10% assistance, so you don't have to use all of it. So if you only use 10% assistance, that means they only have 10% equity share in your property. So it's very interesting. It does give you the ability to come in, not put in 20%, but they will have to, one, have that repaid back, and two, have that percentage of whatever you make from that property in appreciation. So borrowers who qualify for 80% of the average monthly income can access to 20% down with only 15% share. So what does that mean? Well, there's going to be guidelines on how much income per county can you make, and then what we do is we divide that by 80%. So if you fit within that income bracket, you could potentially borrow all the 20% and only pay back 15% in the share. So this assistance is not forgivable. I know there's tons of down payment assistance programs out there. This one is very specific to equity and appreciation. So this is not a gift. This is not a grant. It is an assistance, but it's not forgivable and will have to be repaid back to CalHFA when one of the following is triggered. The sale of your property, you'll have to pay back the 20% and 20% equity of what you've gained. If you refinance your mortgage, that is another trigger that will demand for the loan to be paid back through the equity and what was borrowed. Or if you paid off your mortgage in the next 30 years, then of course you would have to pay back that 20% and 20% of whatever you made in appreciation over the next 30 years, for example. You must occupy the property for at least 12 months. So if you plan on purchasing, you plan on living in it as well. There's a one-time exception to refinance to a lower rate. The balance is still due. So what that means is that there may be an opportunity within this loan, again, looking at the guidelines, that you may be able to refinance in the future to lower the rate without having to pay the balance right away within that refinance because you're lowering your rate, but the balance is still due when you trigger one of the other occasions as well. So some of these loan limits are based on the conforming loan limits of each county. So each county where you're watching this, you may be up north, you may be in the Inland Empire, down south, or in the middle, in the LA, Orange County areas. This is going to be different based on what county you're in. So one of the best things to do is if you don't have that information, connect with us, send us a direct message, or send us an email or get on the phone with us so we can go over that with you as well. So this shared appreciation loan term is that upon the sale or transfer of the home buyer share of the appreciation in the value of the home. So that just means that you're going to be sharing some of the appreciation because the state has put up some of the money for the down payment and they just want that equal appreciation. So it's a win-win for both. I think it's a wonderful program for you to get in and get to know that. It gives you an opportunity to get in and be able to grow over the length of time. So here's an example of how this would work. So the borrower comes in with 80 to maybe 150% of the average monthly income using the Home Ready lookup tool. So if you don't know what that is, we can look it up together and see if which one you qualify for. So on the left-hand side, you'll have a small house with a home value or purchase value of $500,000. And out of $500,000, 80%, the down payment assistance program is going to cover $100,000 of that. So you are going to finance $400,000 of that. And let's say 5 years later, the home just appreciates, right? So how does this work? The home appreciates, you'll have to pay back the $100,000 out of there. And let's say it appreciated to 140. So that leaves us to about, $40,000 left over in appreciation. So you'll have that shared plan where you see where on the left hand side it's paid back with 112 and the remaining is going to be the 28. So as you can see, it'll give you a clear understanding of how much you would get and how much the state would get back as an example of how much a home would appreciate over 5 years if it gained 140,000 appreciation. Now the homeowner sells the home. So it just gets broken down a little bit differently on the right hand side, because it talks about what's left in the mortgage, right? The mortgage is $370,000, and the loan payback would be 128, and the equity would be 142. So this gives you another breakdown of how this would work, of paying the loan back. Now, if you went into a different scenario, let's say that you had the 80% annual income, that you came in and you did the 15%. So as you can see on the left hand side, in the green arrow, it says CalHFA only shares 15% of the appreciation. So again, if you meet the median income of 80% of the median income, this gives you an opportunity to come in and borrow the full 20, but only pay them back 15%. So it all depends on what type of income you have, and that'll come in when you get pre-qualified. So just to wrap this up, we won't have the actual guidelines. The lenders won't have the guidelines until the 27th. So there are going to be a different set of rules for us on the back end. But for you, I'm giving you all of the resources that you need to know if you're on the fence, or you've been considering timing the market, or you've thought about buying a home, but you just don't have the money down. You have the ability to show that you can pay the mortgage. This gives you an ability, especially if you were getting priced out, that let's say for a mortgage that you were going to pay $500,000, now your mortgage is going to be on a $400,000 basis, which makes it a little bit easier for you to pay every single month and be able to still gain some of that equity. And you may have a different scenario that you may want to do, where you're going to maybe use this equity over time and then be able to have a plan for the next 5 years. So eligibility requirements is that the minimum credit score is 660 to 680, because this would be a conventional loan only. There is no FHA option. And the reason being is that this would be a conventional product only. So the max debt to income, or DTI, would be 45%, meaning that we would take a look at your income minus your obligations on your credit report, and we need to come about the max payment that you would be able to afford would be about 45% of what's left over of your income. And if you don't know how to do that, don't worry. That's why we're here, to calculate that for you. The income limits are based on county, so it's the applicant income only, not a household income. So you can't group, 5 people, and it's whoever's on the application. So whoever's applying, that's the type of income that will calculate. And it has to be a first-time home buyer. You can't have lived in an owner-occupied home for the past 3 years. So the properties are eligible are single-family homes, condos, townhomes, or even if you have your eye on a house that's below market value, as long as it's in the right condition, then we can do that. Manufactured homes that are located in their own land, that are not leased, or in mobile home parks. So you have to own the land. You can't be in a mobile home park. This will not qualify for that. So how to apply for the California Dream for All Shared Appreciation Loan. So the applications are first come, first serve, and the funds are limited, meaning once they run out, it's out. So there's only so much hesitation that you can do before the funds run out. So if you're considering this, these are going to be the steps to get you from the point of applying and getting pre-qualified all the way to getting your keys. So the first step is to get pre-qualified, and we do that by collecting basic information like your income, liabilities, or address, and things like that. Then what we really want to do is pull your credit report, access all 3 credit reports, and then upload that to see how much is the current liabilities, the debt to income. Once we figure that out, we collect the basic documents from you: driver's license, income documentation, taxes, things like that. Enough for us to give you a pre-qualification letter. This letter will give you the ability to go out, hand it over to your realtor, and start looking for homes. Once we run the preliminary research, we run it through our system, and we received a pre-qualification letter that we then give to you. This pre-qualification letter turns into, you can submit an offer, and once that offer gets accepted, this is going to be step 5, we then open escrow, which escrow usually will require an initial deposit of 1% of whatever you're buying. So right now, we still don't have the funds from the state. So you still have to anticipate that this deposit, you may have to come up with a deposit. This is very common for you to be able to deposit or submit a 1% deposit of the total purchase price to escrow. And this is just to let the other party know that you are serious about this. So be prepared for some of these ongoing financial commitments that you'll have to make along the process. Now, if everything gets covered, then you will eventually get a refund for it because it got covered by the state, whether you did some of the allocation to cover some of your closing costs. But initially, you will have to be ready for that. So then the next step number 6, is that we submitted these items into underwriting, and then we received an approval letter with some conditions. And don't worry, conditions are very normal. We turn these conditions in because we're looking to get the final blessing to clear to close. And step number 7 is, congratulations, your loan has been received in its final blessing. The numbers balance out with escrow, meaning they know exactly down to the penny how much needs to be distributed to who. And we schedule a notary. That notary then signs the documents with you, turns the documents into the lender to schedule for funding. The loan gets funded in step 8, and once that gets funded, then the house title records at the county level in your name, and congratulations, you have your home. So the process on our end, it's very thorough. On your end, there's not much for you to do besides turn in some of those conditions and wait for the final approval. I hope you found this very informative. Thank you for attending and giving me your time. I want to ask you for a favor. I just want to ask you if I can count on you to send this to any friends, family, or coworkers that can benefit from this program because they don't know that it exists. And the reason they don't know it exists because they don't know all the information that's out there. All these guidelines, they change every day. Sometimes they run out of funds. But right now you have a small window of opportunity to, whenever you're watching this, to reach out. And even if you don't think you would qualify, I would still reach out because we still have programs for self-employed who don't report a lot of money on their taxes, for different types of buyers in different situation. If we can show that you can financially afford the monthly payment, there's always some type of program for someone who has a variable income, who has a lower credit score, that's not always 620, 640. We have programs for that as well. So don't feel like you may not fit this box. And my contact information is on here, so feel free to send me an email or send me a text that we can set up a time and go over your specific scenario. Thanks for watching. This is Raphael, and we'll see you on the next video.